All right, so the next thing we're going to move on to is the fundamental accounting equation. This is something you are going to hear me repeat 10,000 times over the course of this class. You need to know this fundamental accounting equation. I have actually included at the top here a great big warning in bold letters with exclamation points across it, telling you this is one of the most important items in this entire class, and you are learning it on day one. This is going to carry through with you for the entirety of this class. So please, please, please make sure that you write this down, okay? And that you're familiar with it. It really is my belief that if you understand this equation, and later we'll talk about an expanded version of this equation, that you can solve 90% of the problems that you come across in this course, okay? So please, please, please work on understanding it, not just memorizing it, right? It is set up the way it is set up for a purpose, okay? And one thing we'll really talk about a lot in this class is how the transactions that we're discussing impact this equation, because this is an equation and it's always got to be in balance. So this is your equation right here. It's 3 items: assets equal liabilities plus stockholders' equity, okay? That's all this is. Pretty simple to remember, okay? So what are these things listed in here? Well, assets, the left side of the equation, those are just the total resources of the company, right? This is your cash. This is the equipment you own. This is the buildings you own. This is the land you own, right? These are all the assets that you have, the resources at your disposal to help operate the company and help generate more revenue, more income, okay? Liabilities, the first part of the right-hand side of this equation, that's what you owe to creditors. This is what you owe to somebody else, right? So these are things like the amount due on a loan that you've taken out from a bank, okay? The amount due on bonds that you've issued. So another one would be like a payable, like the amount owed to salaried employees, the wages that you owe them. The amount due to a utility company. These are just things that you owe to other people, to creditors in most cases. The last one is stockholders' equity, and this is simply what the owners can claim, their claim to the resources. What do the owners own in your company, right? So we can see that the total of your liabilities plus the total of your equity should equal the amount of assets or the amount of resources that you have in your organization, in your entity. So you can just simply say our resources equal our claims to resources, right? What we owe to people and what is owned by our owners. So the accounting equation here illustrates a fundamental model of business valuation. It is a visual representation of our balance sheet, okay? That's really what it is. And when we get to talking about the balance sheet, you'll see that the things that go on a balance sheet are assets, liabilities, and equity. So anytime you've got questions about, oh my gosh, what should I put on this balance sheet? Does this go on the balance sheet? Is it an asset? Is it a liability? Is it equity? If it is, it belongs on the balance sheet, but we'll get to that later. It's just helpful to know that this equation, that A equals L plus E, is kind of a visual representation of your balance sheet. Okay. So next we're going to talk about revenues, expenses, and dividends. These are all components of retained earnings. So what you saw earlier was stockholders' equity. A portion of that equity is something called retained earnings. Retained earnings are simply the accumulation of profits over the course of the life of the organization. So what do you have left that you could reinvest, or essentially that you could reinvest into the company? So part of that is revenues, and these are the amounts that the company recognizes when it sells products or when it sells goods or services to a customer, right? So different companies are going to recognize revenue differently. So if you're Walmart, you're going to recognize revenue when you sell something to somebody. If you are an auto body shop, you're going to recognize revenue when you perform a service on that automobile, right? When you fix the dent in the fender, or when you replace a transmission, that is a service, and that's when you're going to recognize the revenue. Expenses are simply the costs of providing products and services and other business activities during the period. So this is going to be things like your utility bill. This is going to be things like rent. These are also going to be things that include cost, what we call cost of goods sold. How much did it cost you to sell that particular good, or the cost of services provided? How much did it cost you to paint that house? The paint cost you something. The materials cost you something. Your labor cost you something. Those are all part of expenses. Next, you have net income, and net income is simply the difference between revenues and expenses. We have a simple equation right here. It's net income equals revenue minus expenses. Other common names for this, you can call it earnings, you can call it profit. Typically, we're going to call it net income in this class. If it is negative, if you have suffered a loss, if your expenses were greater than your revenues, then we would call it a net loss. And it goes at the bottom of your income statement. Finally, we have dividends here, and dividends are cash payments to stockholders. This is kind of their reward for purchasing stock in your company, right? This is why investors purchase stock in your company. They hope that the price of the stock increases so they could sell it if they want and get a profit. But also, there are a lot of companies that will pay their shareholders dividends every quarter or every half year or every year, however often they decide to pay dividends. And these are really just kind of a cash reward that are given to the shareholders. Now, dividends are not expenses. Okay, we're not going to worry about that too much right here in Chapter 1, Chapter 2, Chapter 3, but in Chapter 4, knowing that dividends are not an expense is going to become extremely important. So these are all components, like I said earlier, of retained earnings. Retained earnings is a component of equity, which is the E in our fundamental accounting equation. You may want to write that down in your notes, highlight it in the notes that you were provided. It's there right at the bottom. So we're going to move on to learning objective 3. So what we do once we produce these financial statements is we're going to communicate. This is the communication step, right? We've talked about the measurement steps. Now let's talk a little bit about the communication steps, okay? So the primary means of communicating these business activities is through these financial statements. These financial statements, they give the investors, they give creditors, they give other interested parties the information they need to make decisions about a company. Why should I buy the company's stock? Should I lend the company some money? Is management using the resources of the company to operate efficiently? These are the kinds of questions that investors, creditors are going to be asking themselves when they look at your financial statements. So it is extremely important that these financial statements are what we call fairly stated, right? There aren't any misstatements that we know of. Well, not that there aren't any misstatements, but there aren't any what we call material misstatements, something that would change your mind about investing or lending to the company. So these financial statements really are just periodic, right? They're monthly, they're quarterly, they're annually, and they're published by the companies just to provide these external users the information that they're looking for to help them make their decisions. So the primary financial statements that you need to be worried about are the income statement, the statement of stockholders' equity, the balance sheet, the statement of cash flows, and the statement of comprehensive income when necessary. So you can see here, I've marked that last one out. We're not going to cover that statement in this class. Comprehensive income is a more advanced topic for more advanced accounting courses. We're not going to cover it in this class, really. If you need to know a comprehensive income amount, it will be provided for you. You will not have to calculate it. You will not have to tell us what goes into comprehensive income, so we're not going to be covering it. I did want you to be aware, however, that it is going to be mentioned in your text. So just know that it is one of the statements that is produced, but we're not going to be preparing it or working on preparing them in this class. So the income statement. The income statement reports the company's revenues and expenses over an interval of time. So for example, a month, quarter, a year, we've talked about this. This is going to go that entire time, right? So if revenues are greater than expenses, then you have your net income. If your revenues is less than expenses, you've got a net loss. Okay. So the income statement compares revenues and expenses for the current period to assess the company's ability to earn a profit from running its operations. So what is this really telling you? Well, it's just saying how well are they using the revenues that they're generating against the expenses that it's costing them to operate this company to generate a profit for us. Is this company profitable? Is it running efficiently? Okay, and it looks at the entire time period. So an easy way to remember this, and I would take this note down for sure, because this, I think, is just a really easy way to remember what goes on your net income or what goes on your income statement. So the name, obviously, income statement. How do you find income? Well, you find income by reducing your revenues by your expenses. So what goes on an income statement? Revenues, expenses, net income. Okay, so an easy way to remember that is simply think about how do you get to income? Revenues less expenses. Okay, so if it's a revenue, if it's an expense, it's going to go on your income statement. Just a note, I would take that down. It may help you guys in the future.